The resilience of the Australian consumer has been a major area of discussion among investors in recent months. Retail sales in 2022 were 11% higher than in 2021. That was driven by inflation and a normalisation of consumption after the disruptive effect of lockdowns in the prior year. But in spite of the strength of expenditure, consumer confidence has been extremely low since early 2022. The Westpac Melbourne Institute Index of Consumer Sentiment is currently almost as low as during the onset of COVID in March 2020, and it's lower than at any time during the GFC. This can be explained by the near record low levels of unemployment in Australia, particularly youth unemployment, which together with positive wage inflation and household savings that have been elevated since the lockdown constrained consumers' ability to go shopping. But consumers are worried about the future. The savings buffer is being eroded by the higher price of consumer goods and services, while higher interest rates will mean more and more households face the prospect of higher mortgage repayments during 2023. Investors have shared in the cautious mood and came into the new year generally underweight the consumer sector. This underweight position has been costly, as recent credit card spending data, supported by positive trading updates from companies like Super Retail Group, JB Hi-Fi and Myer, have led to the realisation that Christmas trading was stronger than expected, and first half earnings are likely to surprise on the upside. This has driven a strong rally in the ASX 200 Consumer Discretionary Index, which is up 12% since the start of 2023. We believe positive first half earnings releases and full year upgrades will sustain this rally through February. And although we may see a pause for breath after that, the prospect is for consumer stocks to further strengthen towards the middle of the year as sentiment improves against the backdrop of a declining rate of inflation, which may cause the RBA to hold off on further rate hikes. So turning to the upcoming reporting season, there are a number of key themes to watch out for. The most critical information to look out for is the shape of consumer demand. We expect it to have remained robust through Christmas and into January, though it's likely to moderate as we move into the second half of the financial year. Secondly, are consumers trading up or trading down? The demand for big-ticket items is especially important for the automotive sector, while a number of companies like Treasury Wines and A2 Milk benefit from a trend towards premiumisation. Inflation will be a key issue, both in terms of pushing up the prices that are charged to consumers and its impact on input costs and operating expenditure. Better quality businesses will have been able to pass on those higher costs and sustain gross margins, as we saw at the recent trading update from Super Retail Group. We expect extensive discussion around the easing of supply chain disruption and maybe early signs of deflation through the supply chain, notably in the area of international freight. We anticipate that inventory balances will generally glide down as companies move away from a just-in-case strategy back towards a more capital-efficient, just-in-time approach. Capital management is another possible theme that may emerge in February. Many companies built up strong balance sheets over the course of the pandemic, and many are sitting on large franking credit accounts. We could see some returning funds to shareholders in the form of special dividends or buybacks. In the reporting season playbook that the Morgans research team published on the 31st of January, we identified a number of candidates for positive and negative earnings surprise through the February reporting season. On the positive side of the ledger, I'd like to highlight the supermarkets, Coles and Woolworths, which are likely to have benefited from the effect of food inflation on their margins. Qantas may also surprise positively due to its strong cash flow and yields, while the fashion jewellery company Lovisa may impress the market once again with its rate of store rollout and like-for-like sales growth. On the negative side of the ledger, we are cautious about Blackmores and Domino's Pizza on the basis of near-term operating margins. Ingham's may also disappoint as volumes trend flat and inflationary cost pressures have an effect. So our key picks in consumer discretionary are JB Hi-Fi, Beacon Lighting and Universal Store. In consumer staples, we favour Wesfarmers, Coles and Treasury Wine Estates. In the travel space, our key picks are Qantas, Corporate Travel Management, THL and Hello World. In automotive, we prefer Eagers and Smart Group, and in gaming, our key picks are Aristocrat Leisure and Jumbo Interactive. Thank you, and good luck through the reporting season.